Welcome, everyone. So we're going to have a panel this morning about the regulatory space. It's perhaps not the most exciting topic to talk about in the morning, but it's really crucial for the whole space to grow. And we're going to try to make it as interesting as possible. We have a great panel here this morning. We have representatives from 4 companies, from Circle, from VanEck, from OriginX, and from GSR. So I would just like to start this discussion by, letting the panelists quickly introduce themselves and talk a little bit about the company that they're representing here.
Thank you. So my name is Benedicte Nolens. I'm the head of regulatory affairs for Europe and Asia for Circle. Circle is one of the US leaders in the token space. We have an exchange called Poloniex, an OTC desk with our OTC sales right there. So if you need, there they are. We also have a USDC, US dollar coin, which I think you'll hear about later today. Also, one thing you might find really useful is our free research. So you can go online and check, just search Google Circle Crypto Research, and you can subscribe to that research and learn more about these assets. My background is 6 years with the Securities and Futures Commission in Hong Kong, so that's a bit the equivalent of the SEC in the US. And I was, in that regard, leading the fintech efforts, so including looking at the phenomenon of Bitcoin and then later tokenization. And before that, my background is in classic finance.
Perfect. So my name is Gabor Gurbacs. I'm the Director of Digital Asset Strategy at VanEck. VanEck is a $50 billion ETF manager primarily, and sort of we are the Bitcoin ETF guys. Hoping to have some good news for you guys sometimes. Let's see. VanEck manages a lot of what one might call non-traditional asset classes. We built the first gold equity ETF in the 60s in the US. So our gold holdings are around 15 billion, and our founder is a direct student of Ludwig von Mises, so kind of sort of like a relationship between Mises before Bitcoin was cool. And we have all kinds of funds in emerging markets. We built the first Russia fund, Vietnam, Indonesia, the first Chinese tech and biotech-oriented funds, and we are hoping that we'll bring the first Bitcoin ETF to market. Right now, we have, through our wholly owned subsidiary called MVIS, we have the first set of regulated crypto indices. So if you guys are interested in the over-the-counter price of Bitcoin or just generally price of digital assets around the world, then you can see that on our site. I work a lot with regulators such as the SEC, CFTC, and primarily in the US, but also a little bit in Europe and Asia. So that's been why I lost about this much of my hair, as you guys might see later in the, down. And let's see, my background is in mathematics and distributed system. I'm Bitcoin class of 2012. And again, we're hoping to bring you guys the first Bitcoin ETF down the line.
Good morning, everyone. I'm Sandra Wu. I'm one of the founding partners of OriginX Capital. At OriginX Capital, we aim to deliver transparent and tactical advice to our clients, which are typically CEOs or founding members of a project team. What we also do is actually invest. So we have our own investment proprietary fund, which we also use to invest in very, very strategic sort of projects that we like and are also incubating. By way of background, I was formerly a trained lawyer, so private equity, fund formation, and M&A was my bread and butter prior to coming to crypto for about 12 and a half years. And my last position was the Chief Compliance Officer and Head of Legal for Mercer Investments in Asia.
Hello, everyone. My name is Rich Rosenblum. I'm one of the co-founders of GSR. We got started in 2013. We were probably the first algorithmic market maker dedicated to crypto. And we got started market making on behalf of issuers, one of the lead altcoin market makers. The past couple of years, we've traversed market making on behalf of exchanges, also in addition to coins and tokens, market making on derivatives and the burgeoning derivative space that's coming this year. My background prior to that, I was a managing director and head of crude oil derivatives trading at Goldman Sachs, where I was for 12 years. And after that, worked at two New York-based hedge funds.
So now we'll jump into the discussion. That will take about 35 to 40 minutes, and then in the end, we'll have a Q&A session for anyone who wants to ask questions in the audience. They'll take about 2 or 3 minutes in the end. So my first question that I want to jump into, it's kind of broad, but just to get the discussion started, you've all dealt with different regulators. What have been some of the challenges in navigating the space and dealing with regulators?
Do you want us to go in order?
Yeah, or you can just jump in if you...
Oh, sure. Actually, I would love to start with Benedicte. She's the local expert. Or do you want me to?
Well, I can start, but look, I think I find it hard to answer your question because sometimes you can also ensure you don't enter into a challenge with the regulators. So one of the ways to not enter into the challenge with a regulator is not to go into the regulated space. So one of the principal discussions around these crypto assets was what they are, right? What are they? Commodities, securities, or other, right? And so are something new, right? And in the US, the decision was fairly clear, fairly early that the Howey test was very broad. So a lot of them became securities, and then a decision was pretty clear as well on the commodity end. That was not the case outside the US. So through a platform which is called Global Digital Finance, which is a membership-based organization that Circle is also members of, we have formulated to regulators that there are different types of tokens, that there are payment tokens, securities tokens, and then utility/consumer tokens. Now, these things may evolve, but that latter category is the one that in a lot of jurisdictions arguably is not regulated. So the challenge now for the regulators that have taken a view that these are indeed new things and that don't fall in standing definitions of commodities or securities, the challenge in these markets is whether the regulator will build a special regime for them nevertheless. Yeah, we'll get to AML later, but it seems the direction is now to focus from the regulators, and it's a pretty broad direction, is to focus on the AML side first, rather than on creating special regime. So there is this difference between the US and outside the US, I dare say, on this definitional end, and it will have different outcomes, I think.
So my experience with regulators is sort of on the highly regulated side. At VanEck, we think that basically the everyday investor should have the right to invest in digital assets in the same way that we invest in securities, commodities, or futures today. Since the digital asset space is not very well established right now, that is not the case. So people buy digital assets on different platforms that are state regulated or not regulated at all, or as Benedicte said, sort of like outside the jurisdiction. So we, again, our job, and this is kind of non-sexy work that we do, is to bring digital assets in some ways to the existing frameworks, and we believe that actually it's possible. So one of our initiatives is the Bitcoin ETF initiative, which would give the everyday investor the opportunity to buy Bitcoin in an exchange-traded fund with the same sort of like safeties, rights, and insurance and operational processes that you're used to on the equities market. There's a ton of work to do to get there, and when we started working on it roughly probably first conversations around 4 years ago or so, we realized that there's no specific pricing that can be used for a fund. Custody of digital assets today are still problematic because we don't know, as Benedicte mentioned too, that what is the classification of certain digital assets. Then another idea that regulators are asking a lot is surveillance and market manipulations. Are the exchanges that, or really crypto trading platforms, because they're not, most of these websites are not fully regulated and don't provide the safeties that you're used to in the equities and futures space, are they clean enough so that the everyday investor can participate in it with the same protections as for equities? So slowly on the pricing end, we built indices for both. Sort of like we have data feeds from 150 trading platforms or exchanges globally. We work with the largest over-the-counter trading desk, including Circle, to provide some transparency into the over-the-counter markets. We're working with the lead custodian candidates in the space, and you might have seen on the surveillance and so VanEck's index subsidiary, MVIS and NASDAQ, is right now surveilling about 3 digital asset exchanges in the same way that you're used to for larger markets, and there's four additional one in the works. So really the digital asset space is growing up. Generally from our ETFs, we have seen 3-5 years of work before a new asset class come to market, and I'm hoping that Bitcoin and other digital assets will take about the same time. Right now, again, it's a lot of ground up work, and I invite you, if your company wants to participate in sort of like a more highly regulated space down the line, then we're happy to work with everyone, and we're working with the leading exchanges and over-the-counter firms already. Yep, so that's my note for now.
So I can talk about the regulatory landscape from Hong Kong and US, because that's where a lot of my clients come from. So speaking from the project teams or the funds that have decided to form a new entity in Asia, what is that like talking to the regulators in Hong Kong? So one thing that's quite confusing for a lot of asset managers who are looking to expand their operations into Asia is the fact that the regulators in Asia themselves aren't really clear on exactly where they want to take the licensing regime, for example, for an asset manager. Do they need a 1, 4, and 9, which are the licenses in Hong Kong? What sort of aspects are they looking at in terms of the custody solution to sort of give the regulators comfort around the custody of the asset? Is it done by a third party? Is it self-custody? Is it susceptible to the SFC? So one thing, besides traversing through the various jurisdictional landscape in terms of a regulatory perspective, I think just within one country, such as the US, you see a divergence and fragmentation of the classification of cryptocurrency. So as Benedicte has correctly pointed out, the SEC sees cryptocurrency as a security. However, CFTC sees cryptocurrency as a commodity. OFAC sees it as fiat money. But when you see IRS, they treat cryptocurrencies as property. So that divergence and fragmentation of classification is quite confusing, and naturally so for any founders or CEOs who are starting in this space.
So one of the main challenges we see is that due to the global nature of crypto and the ease today of extraterritorial jurisdiction, not only have to know just 1 or 2 countries or regions, but you have to have a PhD in island republics to know the changing laws in each jurisdiction and try to follow them based on where your customers are coming from, what kind of services you're allowed to offer them.
Yeah.
Cool. So now I want to briefly talk about the regulation regarding ICOs. And so in late 2017, ICOs basically fueled the bull run. And most of them since then have crashed by 90%, some of them by even more than 90%. And so my question to the panelists is, could more aggressive regulation, could it have prevented, that irrational exuberance, like Greenspan called it in the early 2000s, could that be prevented by a more aggressive regulation, and could that, prevent investors from losing so much capital?
Okay, I'm happy to take this one. So yes, of course it could have, but I think you need to think as well about what on the other end of the spectrum that would have meant. If the regulators had on day one applied all the rules of securities law, and if they had done that globally, then there wouldn't have been that capital raising, which is estimated around 16 billion. Now, I don't want to speak for the frauds, but let's say in the non-frauds, let's say there are people much better positioned than me to distinguish these projects have raised capital that they can now use to build this blockchain infrastructure and ecosystem. And I think we were just discussing on this panel how early days it is for some of the legal questions, or the valuation questions, or the tax questions. It is equally early, frankly, to make a decision even as to which blockchain is going to be having more adoption and for what type of activity. So most recently, for example, regulators are questioning settlement finality in the context of public blockchains. So these kind of questions still need to be resolved and are largely dependent on consensus mechanisms. So if there is no one working on the consensus mechanisms because no capital would have been raised for it, we would not be either where we are today. So yes, it could have avoided that, but on the other hand, probably we wouldn't all be in this room, right? This kind of creativity burst that there has been wouldn't have existed either, right? So the valuation burst wouldn't have existed, but the creativity burst, or the amount of talent that moved into the sector, would not have happened without that burst. Now, secondly, what you see right now, which I find really interesting, is that there are some natural forces at work here, and the natural forces that people now start realizing this, and that's why you hear a lot of talk about STOs. Suddenly people go like, okay, maybe ICOs, maybe what you're saying is they are too unregulated and therefore people want to go for STOs. But as said, one should not ignore that STOs use the word security and consequently are a 100% regulated product, which means that it will need to jump through these different regulatory definitions and hoops in every single country. And that includes questions around, as I said, settlement finality, custody, and AML. I think those are really the big ones. And normally what regulators tend to do to protect let's say themselves in the market is to limit these distributions then to sophisticated investors. So anyway, I think in concept people have jumped, but in practice, these other things that I mentioned still need some form of progress.
So generally, I advocate for protecting innovation, and I think some of the ICOs out there in the market, it's really bad that we don't have enough information on what to do. So in my opinion, most of the ICOs are securities, and actually that is what the Securities and Exchange Commission, including the commissioners, say as well. So might as well worth registering your ICO or fund offering, or anytime you raise money, try to fit into, before you start a crypto business, see if your offering fits into an established framework. And I think a lot of the ICOs missed the opportunity to register as a security, but maybe you should at this point. A number of them are actually started doing that because for a few reasons. One, legal action, obviously everyone fears from that, but secondarily, the global capital markets bring a lot of liquidity to projects, and it is possible that you find more investors if you register your offering under an established framework. And you will have a much easier time going to a regulator saying that I'd like to fit into an existing system before, rather than saying that we want to build a new system. It takes time to build a new regulatory framework, and it will happen eventually. But before that, again, maybe look for in the United States, there's something called Reg A shelf offering, so you can raise $80 million to your project, registering your work, and that's okay. I think a startup with $80 million of funding should be more than enough, and then raise follow rounds. But again, I think it's best approach is to register, talk with your regulators, don't be afraid of them. I think there's real benefits to start a conversation early. And even if you have a project, engage with them and have a good legal counsel. Make no mistake, actually, for about, I think, roughly a year, the SEC has a person who is probably monitoring the entire ICO space, takes snapshots of that and saves that. So everything that is public is available to the regulators too. And regulators are very up to date with the space. So start your conversation.
It will be interesting to see what projects and teams would actually do an unwind of the raise and restart all over again, actually.
Yeah.
Yeah. I think, could there have been more aggressive regulation to sort of prevent the bubble? I think the answer is no. Greed and fear are natural human behaviors, right? And this is what fueled the ICO bubble of 2017. So I don't think there is any regulation out there that could have been implemented, that could have been more aggressive to stop the bubble that had occurred and the subsequent bear market. However, what we could have seen was definitely a reduction in ICO scams, Ponzi schemes, and just shady operations, right? And shady raises. Now, that could have been minimized and sort of encourage quality projects, quality teams to really surface. However, I don't think any regulation or any regulator could have prevented what we had experienced in 2017 and 2018.
I'd say it all really depends on how severe the regulations would be. Because if every single person who bought Bitcoin had to be KYC'd, most in this room probably wouldn't have heard of Bitcoin by now. So when it comes to Bitcoin specifically, I think it helped in the early days. But then more about ICOs and the phenomenon of 2017, if there was just stricter regulations to prevent as many ICOs to come to market and fund, I think that could have changed the trajectory of the shape of the market. And I think what happened in 2017 with the parabolic rise of Bitcoin, people cashed out and they'd made money so quickly, they then put their dollars into some of these ICOs. So if they didn't have as many avenues to reallocate their capital, I think you could have seen an even bigger peak in Bitcoin and perhaps not as big of a trough because they didn't have alternatives. I think it also would have preserved some of the integrity in the space. So I think you could have had more institutional entrance if there was less distraction from Bitcoin.
I think one thing to add is actually bubbles are marked by severe hype marketing, speculation, rampant speculation, deep pockets. I think if there was regulation around the marketing of ICOs, that would have been quite effective. A lot of the times you saw influencers actually advocating for a particular coin. Imagine if the influencer had to say, hashtag, this was actually sponsored. I was paid $2 million to actually, advertise this coin. I think people would have been more wary of the offering itself.
So I have a follow-up question to the ICO issue, and that is in now the famous speech by William Hinman, who is the director of the Division of Corporation Finance at the SEC. He said that when an asset is sufficiently decentralized, he doesn't think that it is a security anymore. And a similar thing was said by Hester Peirce lately in her lecture, where she said that tokens sold in a functional network are no longer securities. And even though these are just their opinions, they don't represent the SEC. But my question here is, is the SEC or are the regulators really in a position to make the call if something is sufficiently decentralized? What's the threshold for decentralization? How do you determine that? How can you determine whether a network is already functional? What are the criteria? So my question to the panelists really is, are regulators in a position to determine these issues?
Sure.
I'd say currently, while it's possible, I think it depends on the regulator. A lot of the regulators just don't have the employee manpower or the education to make those decisions on a quick basis. But over time, I think they could. And it's not as if it's a problem that's too difficult to solve. Like, they can be masters of points where there's nuances in a situation when it comes to market manipulation. Often they'll follow a case for multiple years before they can prove something beyond the shadow of a doubt. And one of the terms that's often used is they need a mosaic of information. It's not just one piece of information that's used, it's a blanket of facts used to make a determination. So I think that even if it seems like a difficult question, I think it's certainly within their power to make those determinations.
So I'm actually, you guys might have seen some of my tweets around it in response to the Coin Center piece on whether Ethereum is a security or not. I think, you make no mistake, actually the chairman of the SEC or the commission never said that Ethereum is not a security. Director Hinman said that Ethereum may have been a security at issuance, didn't explicitly answer whether it was or not. If yes, it was an illegal offering. If not, no. And right now, it may not be a security. There was no, so all that, what you see recently in the news is all fake news. There's no new information in the market around the status of Ether or really any other sort of like tokens in the space. It's all, what the SEC says is that every single token is evaluated on a facts and circumstances basis. So what that means is that they look at it one by one and evaluate whether that's a security offering or not. Most of the tokens out there are security offerings because they raise they raise money and then fund the project in one way or another. My advice to you guys in the space is be ethical about it, because every single dollar raised from an investor is debt to the investor. It's a promise that you will deliver of equal value or better. Or it's on a, sure, you may lose money or not, but I think most of the ICOs today just sort of lived up the enormous amounts of money raised, and that's a big problem. Again, register I think it's just important to register anything that may look like a securities offering. And my firm is actually exclusively right now focused on Bitcoin, because Bitcoin is a commodity, and it's fairly clear in the United States from CFTC guidance that it is.
So just on the sort of concept of sufficiently decentralized, I believe the SEC was looking at the concept of where it's that stage where the purchaser or holder of a token no longer reasonably expects a person or a group of person to either sort of engage in sort of managerial efforts to sort of manage the network, right? So there is no central role played by the initial issuer. That's what sufficiently decentralization means. However, what about the in-betweens, right? Where you have the birth of that network, but at the same time, it takes time to develop it to become sufficiently decentralized. SEC hasn't given any guidance on everything in between these two stages. Likewise, with the concept of a functioning network, how it will fall outside the rules of securities if there is a functioning network. So from my perspective, the only clear fact that is unequivocal here is if a project is raising on the back of a white paper only, no code in the GitHub, and nothing is actually functioning, right? That to me puts it automatically in the securities bucket. However, everything in between, again, is contestable, and it's up for interpretation. So, for example, if, I don't know whether testnet or mainnet will be considered functioning, and then you've got other shades of gray there, which is mainnet launch 1.0, where you have certain aspects of functionalities of the network being released at 1.0 release, well, the mainnet release, and then 2.0. There'll be a greater number of functionalities released then, and then 3.0. So at what point would the SEC consider that as a functioning, fully functioning network? Question marks.
Can I add actually a quick note? And this is the whole sufficiently decentralized in the meaning. I think it's downright stupid to look at something, whether it's a sort of like, if something is sufficiently decentralized and it's not a security. There's 4 additional points on whether something is a security or not, and you cannot measure decentralization. The ETF market making system is decentralized. The internet is decentralized. Some of the capital markets functions that we are used to are technically decentralized because owners in the process are different entities. Is that a decentralized network? No, they fall under securities laws. So I think this idea of measuring something, whether it's a security or not, purely in the decentralization basis is a slippery slope. And I have a hard time believing that in common law systems, we will see. So if Ethereum, for instance, was not a security, that would set a precedent, and everyone would start raising a ton of money and say that my token turned into something sufficiently decentralized. I don't believe that that's a good approach.
So another question, I think this will be pointed specifically a little bit more at Gabor here, is the question regarding ETFs. So he's perhaps one of the most crucial people in getting the Bitcoin ETF on the market, and it's taking the SEC still a lot of time to get comfortable with the ETF, and there's several factors. One of them is custody. One of them is market manipulation. So I want to ask Gabor specifically, what have been some of your learnings from dealing with the SEC regarding with the ETF? What do they think is really, the most crucial step in getting the ETF to the market?
So yes, I'll be quick with this. So the world wants a Bitcoin ETF because investors are used to protections, and I think investors do deserve those protections. So we've been working with the SEC for years now, and basically we had to build a market with some of you guys from the bottom up. So we need proper pricing, evidence that the markets are surveilled and not uniquely manipulated compared to other markets, and proper custody solutions. So through various partnerships, we believe we have the right pricing solutions, and we believe that we can prove that the markets are not uniquely manipulated compared to other equities, futures, and commodity markets. The only outstanding question, in my opinion, and I think that's some other people think too, is custody. So right now, the large banks of the world are not custodying digital assets. So hopefully that will change down the line. And I think again, just to emphasize, I think it's unfair that today the average investor has to go through random offshore, whatever the term was, tropical island jurisdiction to get access to Bitcoin. Why can't someone just buy it through a regulated instrument? I think in the future, that will change. And Bitcoin is, again, basically known to be a commodity. So an ETF based on that would be a commodity-based security. And if that was approved, then I think that might change quite a bit for the digital asset space. I put a lot of content out on Twitter and other places on this if you guys want to follow.
Just a quick, follow-up question to that. There's still, the SEC still has an issue with market manipulation. And a lot of the underlying exchanges where most of the liquidity comes from are still unregulated, right? It's Binance, Bitfinex, BitMEX. Is that an issue at this point that a lot of liquidity comes from these exchanges, or is the SEC okay with just having the regulated exchanges as the basis?
So specifically to this point, our ETF is priced based on over-the-counter trades of Bitcoin. So the entities we are dealing with are either broker-dealers or affiliates of broker-dealers that transact large amounts of Bitcoin. The OTC space is somewhere between really 20 to 50% of the market. So we have Circle, Genesis, and Cumberland are partners in this space, and we have appropriate agreements with them. And some of the large, through a separate project that I'm working with NASDAQ on futures and surveillance, I think 3 of the exchanges today are signed up already for surveillance, like equity markets and information sharing agreements. And we are open to register other exchanges as well and work with us, and also help protect the exchanges. So that's kind of what I do: try to protect the exchanges from regulators, and at the same time satisfy regulatory requirements. So it's getting up there. So we have large OTC market makers sort of getting into the space with sufficiently large volume, and that's what our ETF is based on. And they are broker-dealers. Again, some of them have higher requirements than gold and other commodities. And so my answer is we have sufficiently surveilled volume for the purposes of a Bitcoin ETF.
So another question now, I think the most appropriate for Benedicte. Some of the companies in the space, cryptocurrency space as a whole is a global phenomena. Some of the companies have been known to, go from jurisdiction to jurisdiction until they find the most favorable one that maybe has the least friction. So my question is, how does Circle view the strategy? Because, in theory, it could actually, it's harder to compete against companies that don't have the same rules. So, for example, we look specifically, at Binance. They've been moving from one country to another, and now because they have, the least or the most favorable jurisdiction, maybe it's easier to compete, and they have a maybe unfair advantage. So I'm curious how you view that.
Yeah, I don't want to speak about a specific company, but definitely look, that is a strategy, and it is, in fact, frankly, becoming increasingly prevalent as opposed to less prevalent. And the reason why it's becoming increasingly prevalent is because the developed market regulators have a hard time deciding what to do with this asset class. As said, for the reasons previously set out, because it's not one thing, it's the application of technology to many different aspects of finance. Secondly, as I mentioned before, there is a new thing in it, which are these consumer and utility tokens. The other new thing was to try and place these things without prospectus, without a revenue model. So there's a lot of new things in that developed market regulators are just concerned about creating new frameworks for at this time. So then naturally people start hopping around to little markets that either come up with the framework of some sort or that otherwise are frankly not regulating at all. So I've been looking at this, and there definitely is a series of favorites in that regard. Let's say Malta, for example, came up with a regime, but the reality is, if you read that regime, which I did front to back when it came out, it's very clear that they're not denying the existence of European law. So the moment it's a security, you're into European law, including MiFID. So let's say if I hop with a platform to Malta and I start offering securities, I'm actually violating European law. And what may happen is that Malta doesn't enforce that, but you have a long-term liability against you from the European authorities. And there is actually a history to the EBA already having gone after Malta for certain practices. So it is not to be excluded that European regulators point in that direction and say, look, that line of security was infringed upon. I've seen other examples. I've seen one in Vincent in Grenadines, which I still have to find out where it is actually. But interestingly, that island or that platform in that island, if I recall well in the future space, is then limiting the offering of that platform, meaning that the residents of even that small island can't access it. So it's not only an unregulated island, it's on top of it a place where then they try and protect themselves this way. We've seen many other examples in many other different islands on Earth. So yes, it's not something we can stop, because it's going to be up to every single party to choose that for themselves. I would say, though, that these broader trends we discussed are much more important. So the fact that there is such deflation in the token prices for tokens that were ICO'd will lead to less retail and institutional interest, and then points in the direction of needing to go, as I said before, into the regulated direction anyway. And then if you want, as you mentioned, liquidity, then you have to go for leading market regulation. You can't do that from a small island. So the question is, are these kind of advantages temporary advantages as this market anyway is pushed to evolve? And not only pushed to evolve, but frankly, as it becomes able to evolve. Because as said, the custody issue is not resolved. The settlement finality issue is not resolved. So until we have solutions for these things, is actually maybe not, I can tell you for sure that some leading regulators are not going to approve the product until these issues are resolved. So as said, if you want to do a regulated product, then these issues need to be resolved. The infrastructure needs to be in place. So I think we'll be in this intermediary period of this kind of island hopping continuing for a while. But long term, yes, for healthy markets, you probably need a level of regulation, and you need it in developed markets. I did want to add a small point on the prior discussion on fraud in ICOs. And this is a point I've prominently made in the GDF, Global Digital Finance, since very, very early last year, is anybody who thinks that isn't caught by criminal law is just, frankly, not on top of even the most basic of laws, which is criminal law, right? So you don't need a securities regulator to say that was a failure of disclosure and was a security. No, in fact, you just need the police knocking on the door and saying you committed a fraud, you issued a paper, and the content of that paper created some misrepresentations. And the other thing I would also say on the security side is we mentioned whether regulators acted fast enough. I frankly think they did, because if you look at the history of them making statements on the limits of their security law, it started with the first statement by the SEC in the summer of 2017, not 18. And if I remember, it was only about 3 months earlier that the Dow phenomenon had started. So I think it is just that people weren't reading these consecutive statements. So let's say the Hong Kong SFC has one out there right away in August or September as well. And they can all be accessed on a website for IOSCO. So if you do IOSCO crypto, you can find the full list there, and you can see the chronology of it. So it's not like they didn't act, they actually did. But it came so fast that they could only do what they did. Yeah.
So we're running out of time, but we'll take 2 questions from the audience. So whoever has a question, feel free to ask.
Hi, well, I have a question regarding regulated securities on crypto assets. So there's already been some issuance of exchange-traded notes here in Europe. XBT Provider is probably the most known one. What's your view on that, and do you think that Europe might be a leading the front on that?
I don't think I understood the question.
I think he's asking about the fact that ETFs are basically...
We couldn't hear it. It was too far from the mic or something. He's moved on. Did you hear it?
I think he's essentially asking about ETFs in Europe and why essentially been able to have ETNs or equivalents to ETFs in Europe.
I can quickly answer the question. The reason is because right now there are 2 products out there. So one of them is recently the AMA1 Multiasset kind of crypto ETP, which we actually helped on the pricing side to launch, and that's isolated to the Swiss market. And it took 2 years for the Swiss market regulator to get comfortable with basically a structured product, which is a very small market offered to a limited number of investors. And so that's sort of isolated small market offered to a limited number of investors. On the Swiss side, I don't want to be specific, but the idea there is they have a node issued locally with again a regulator that got comfortable with another offshore jurisdiction on an island, and it's an exchange-traded node where someone, an organization takes the counterparty. You have 100% counterparty risk with the issuer of the node. Eventually, I hope that we'll see an ETF where you don't have counterparty risk with your issuer. And as Benedicte mentioned actually earlier, I do believe that we need liquid capital markets to these solutions. And right now, the jurisdictions like Switzerland is $1.6 trillion. Only a small fraction of a percent is in structured notes, so it's a small market. Sweden is also an even smaller market. We need larger markets to be part of this space, and a GA jurisdiction will be great. And my prediction is that in the next 1 to 3 years there'll be a GA jurisdiction that will get comfortable with at least Bitcoin.
I've got a question. I'd say, given there's been so much time for institutions to figure out, as well as retail, to figure out ways to get long Bitcoin, how much of an effect do you think there will be on price if we did have VanEck Bitcoin allowed?
I don't like to speculate on price. I think I don't know. I think there are more important things about Bitcoin that most people tend to underestimate, and the more important things that it's and this is my personal belief, but it's trust minimized, non-sovereign issued, sound money, and there's way more important than price.
Well, instead of price, how much capital do you think would be contributed the first year?
Oh, I can't be specific on the first year, but I think most of the institutions are not in the space. On the sort of like the retirement funds, larger banks, they simply cannot get in here. So one example is that when we launched the first gold fund, gold was around $200 million total market capitalization. That was in 1968, and gold is around 7.4 trillion now. Again, maybe Bitcoin will get there, maybe not. But one thing is for sure, regulators need to get comfortable with Bitcoin to the same level as gold at least in order for the space to grow. Otherwise, I think we'll just see consistent shrinking. And make no mistakes, actually, regulators have not delivered a decent punch to the space yet. So that's just something to keep in mind.
Any last quick question?
Hi, how are you? Tone Vase. Two quick questions. Hopefully you can answer them both. So one of them is lately the terminology has changed from ICO to STO. Is there really a difference? And the other question, do you feel that companies that did ICO had a competitive advantage over their competition, like Binance, for example, became the biggest exchange so quickly because they ICO'd, but the other exchanges that were there before them did not?
So just to answer your first question, is there a difference between ICOs and STOs? Yes, there is. An STO is essentially an ICO, but within the current legal regulatory framework that we're all operating in, right? So if you were to conduct an STO in Hong Kong, you need to comply with Hong Kong's marketing rules, offering rules, and also the documentation around the offering has to be all vetted and properly done by a law firm. Now, an ICO back in the days, you could have done all that within 3 to 6 months from inception of idea without even a law firm involved, right? Because there were so many SAFs and contribution agreements running around. People were just cutting and pasting slabs of these clauses and compiling it themselves, right? However, with an STO, there are regulatory guidelines. In the US, for example, there's the filing requirement if you do a Reg D. So there's pre-filing and also post-filing within 15 days of the initial first offering. So there are rules that you need to abide by to do an STO. Just on the point of marketing, now you may be offshore, such as in the Cayman. So you may have an entity incorporating the Cayman to be the issuer of the STO. However, if you have boots on the ground in Hong Kong or in the US, you are still subject to US and Hong Kong regulations if there's active marketing by those individuals on the ground. So you can't escape those rules in any way.
For the second question, I'd say that if you're an exchange, whether you have your own native ICO or not, is that an advantage? I'd say it gives you a unique funding advantage because it's another tool to raise money. But I think overall, it's more of a negative and it disadvantages you. Exchanges are meant to be extremely impartial and not have ulterior motives. And when you're marketing your own token and encouraging people to trade it, whether it's an access token or other use case, I think you wouldn't see an exchange like ICE's backed the proper institutional exchange function that way. I think that it's worse than just a distraction.
Yeah, and I think the other thing to add there is it's important to look at the definition of securities again, right? Normally, if there is a right to any form of earnings, it gets very close to security. So it's still a question on how that's to be tested. The other thing is the motivations that the token provides on the conflict level is another important question to ask, i.e. does it encourage let's say wash trading or something like that. These are questions I think to ask if anyone wanted to do that, let's say in a principal market.
Yeah, I think that's it. We've run out of time. So thank you everyone for paying attention and have a good time.